Hey, welcome to the Dude Real Estate channel. I'm your host, Nate Shields. Today we're going to be talking about a value add multi-unit property. It's a 20-unit apartment building that we bought in 2018. We're going to take a pretty deep dive into some of the numbers. We're going to talk about how we found it, what we liked about it, some of the original numbers, how we financed it, the appraisal, how we were able to push rents quickly, how we were able to do that without putting much money into the property. We did make some improvements. I'll go over those. We'll go over some of our current numbers. I'll tell you my opinion of the current estimated value and our future plans for the property. And I've also got 3 tips a little bit later in the video when it comes to value add opportunities for multifamily. Let's dive right in. All right, how we found this property. We were looking for a commercial property, most likely an apartment complex under $1 million, somewhere in the US in a decent market. So we weren't terribly picky, but we were looking for deals, sifting through deals in larger metro areas. And my partner, he actually found this deal on LoopNet. LoopNet is typically where people say deals go to die. The reason they say that is because a lot of commercial properties are traded off market. If a commercial broker can't find a ready, willing, and able buyer from their buyer's list or their sphere of influence, it typically will go on LoopNet. So maybe some of the deals on LoopNet are not as good because already some buyers passed on it. So they passed on it for a reason. But there are still a lot of deals to be found on LoopNet. You just got to dig pretty deep. So in this case, my partner found it. He looked at some of the initial numbers on it and something seemed just kind of off about the numbers. The revenue seemed really low for the property for some reason. So we dug a little deeper. We got the T12, which means the trailing 12 months rent and income. We looked at the tax returns, and that's actually where we saw something that was misreported. And so that made us think, okay, once we analyzed the numbers, it actually looked like a pretty good deal for us. And it gets even better, which I'll get into in a minute. So that's how we found the deal. The deal was in Alabama, outside of Huntsville. We really did know what the condition of the property was like. We figured it was a C-class property. We knew the age of it, so we weren't expecting anything out of the ordinary with the property itself. What we were more concerned about was that we didn't know the area and we didn't know the property manager. So we flew down there to check it out, spent a couple days down there, toured the property. It was exactly as we thought. But more importantly, we got to know the property manager who had already been managing the property for 10 years. So that was super helpful. We also toured the general area. We didn't even realize that it was fairly close to the University of Northern Alabama, and the demographics of the area were actually fairly strong. So what we liked about this property was the fact that it was in a good area. It seemed like it was a growing area, and all the rents were artificially low. So we knew that that was our immediate value add. A lot of the rents, and you guys are probably going to laugh depending on what part of the country you're in, but 20-unit building, all of them were 2-bedroom, 1-bath apartments, and they were renting for around $350 a month. Now around here, that would be, triple, quadruple that. And I don't know, comment below what rents are like in your area for a 2-bedroom, 1-bath. But crazy low, but there's still opportunity to raise rents pretty immediately without any negative side effects. So we thought that we could raise them to around $400. So raising the rents by $25 to $50 and in some case $75 across the board as we had turnover was going to increase not only our revenue but our NOI, which increases the value of a commercial property. So we are still doing some turnover with some of the units, and as we are going along, we are actually raising rents up to $425, even $450 in some cases right now. All right, how did we finance this property? So our commercial lender that we'd worked with on our other deals prior to was able to finance the debt on this, and we had a line of credit with our lender as well. So essentially we used our line of credit as the down payment, or roughly $100,000. I forgot to tell you the price. Price of the property, it was listed at $575. Now this is where it gets really good and interesting. It was listed at $575. We settled at $475. So, okay, that's great. We got $100,000 off, but we were really interested in what it was going to appraise for. And it immediately appraised for $573. So on closing day, on paper anyway, we made $98,000. That was without even adding any value. So we bought the property really well. And essentially it was kind of like 100% financing because we used our line of credit for the down payment. So our cash flow gets hurt a little bit by that, but when we refinance or sell some of our other properties, we'll pay off that line and that will help increase our cash flow. So some improvements that we made immediately to the property is the outside, the grounds looked a little dumpy. And so we added some landscaping, cleaned it up, power washed the buildings, stuff like that, just to kind of spruce it up. We weren't going to do anything to the interiors quite yet. They were okay, not awesome, but we have some plans in the future for those. So like I said, our current numbers on the property, we still have some apartments that we're turning over, but as we do, the rents are going at $425 pretty easily, in some cases $450. So I think our current estimated value, and this, you never know because we don't know exactly what the cap rates are running in that area, but I'm guessing at an 8% cap rate with the NOI that we have right now, property's probably valued around $650, something like that, and there's still room for us to make some improvements. So our future plans are actually, as we get turnover, we're going to do some light rehabs, $3,000 or $4,000, change out some flooring, some lighting, new vanities, new countertops, stuff like that, and see if we can even push rents higher, maybe to $475 or $500, and see how many units we can apply that to. Maybe it's just a couple, maybe it's none at all, or maybe as we go forward, we can do it to all of them and get a really nice ROI on some light rehab of the property. All right, I've got 3 tips when it comes to value add in commercial property, 3 things that we learned through this process. So one is management. Make sure that you're vetting the management very hard. In most cases, a commercial property is probably going to be managed by a property management company. That was the case with us. Luckily, we felt really good about the property manager that was already managing it, and he's done a really good job for us. Sometimes though, there is an opportunity to bring in new property management. So potentially you might get a good deal on property because it wasn't managed correctly and you need to bring in a new manager to make sure that everything is being done in the best way possible. All right, number 2 tip for commercial properties, you really got to dig down into the demographics. It's super important when you have multiple units that you know your demographics inside and out, that you know what the demand is for the type of housing that you're going to be buying. A lot of times I'll see these properties that seem like a good deal, but then you realize that they're only 30 or 40% occupied. So probably a mistake someone made was either they mismanaged the property or they didn't understand the demographics and the demand of the area, and they were never able to get the units full. And tip number 3, realize that if you're coming from single family or smaller multifamily and you're jumping into a mid-size apartment building, that your expenses are going to be higher, especially on the front end. So you might have some bigger value adds. So you might be renovating units, which can get really costly, or it could just be stuff too, like a home inspection or the appraisal. For us, the inspection costs $2,300. Typically for a single family home, it might be around $400, $450, something like that. And the appraisal cost us $2,200, and I had quotes as high as, I believe, $3,500. That stuff can get kind of expensive. Typically an appraisal is going to run you, $500 on a single family house. All that to say, this was a really good deal for us. It's been a good cash flow property, and we continue to increase the NOI. We will probably refinance in the near future, in the next year or 2. I mean, rates are really, really low right now, so it might be a good opportunity for us to do that. But we're still trying to press some of those rents a little bit higher. And like I said, we're going to try to do some light renos to push those rents higher there as well. If you got any questions, let me know. But I will see you in the next video. Later.